Something very strange is happening in the market right now. It's that quiet part of the cycle, that moment where everything on the surface looks okay. But if you're an experienced trader, you can feel the tension building underneath. Volatility is crushed. The news headlines are calm. All the commentators seem relaxed. But the price action, what's actually happening with the numbers, tells a completely different story if you know where to look. Because what we saw today in silver and the silver mining stocks should not be possible in a normal, efficient market. Let me walk you through it. Silver sold off, and it sold off hard early in the trading session. It was a sharp, fast drop that broke through key technical support levels and triggered a whole cascade of stop-loss orders. It's the kind of move that looks like pure panic selling. The kind of move that convinces all the nervous investors, the weak hands, that the rally is officially over and it's time to get out. But here's where it gets weird. While physical silver was getting hammered, the mining stocks barely even reacted. I mean, not only did they not follow the metal down, they stabilized almost immediately. Some of them actually started ticking higher, while silver was still under intense pressure. Now, that is not normal behavior. In a healthy, rational market, mining stocks are supposed to be leverage plays on the metal itself. They're supposed to move more than the metal, not less. When silver drops 4%, the miners should be down 6, 8, maybe even 10%. That's just the nature of how operating leverage and equity risk work in this sector. But today, silver took a nosedive, and the miners barely blinked. That is not a sign of weakness. That is not a random fluke. That is what professional traders call relative strength. And seeing relative strength during a big sell-off is one of the most powerful signals we watch for when a trend is about to reverse. Why? Because it tells you that somebody, somewhere, is buying quietly while everyone else is selling loudly. Someone with deep pockets is accumulating shares while the retail crowd is panicking. Now, let's add one more detail to this puzzle that changes absolutely everything. We are less than 24 hours away from monthly options expiration. This is, without a doubt, the single most dangerous day of the month for anyone holding large, short positions in the market. On options expiration day, billions of dollars in contracts either expire completely worthless or are forced into settlement. And if the price moves the wrong way against those big, short positions, the market makers and the big banks are forced to hedge their positions in the open market. That means they have to start buying shares they don't want to buy at prices they can't control. This forced buying is what creates explosive, face-ripping rallies. And right now, the key strike levels, and the prices that really matter for these options contracts, are sitting right around the current price of silver. So what does that mean? It means this isn't just about silver falling today. This is about a very deliberate effort to keep the price of silver, and especially the silver miners, below these critical price levels until those options contracts expire. Because once expiration passes, that downward pressure vanishes. It disappears, and the price is suddenly free to move again, free to find its natural level. Now, let's talk about the elephant in the room, the thing nobody on mainstream finance TV seems to want to discuss: valuation. At current silver prices, most of the major silver mining companies are generating profit margins that, historically, we've only ever seen during the absolute peak of commodity supercycles. They're all-in sustaining costs. The total cost to get the metal out of the ground are relatively stable. Energy prices aren't exploding. Labor costs aren't doubling. But the price of silver is way, way up. And that means every single extra dollar in the silver price goes almost directly to the bottom line as pure profit. That is the power of operating leverage. And it is absolutely brutal for anyone shorting these stocks, because their earnings are exploding much faster than their stock prices can keep up. But here's the problem. The market is still pricing these mining stocks as if silver were back in the low 30s, not where it is today. It's like the market is behaving as if these incredible profits don't exist, as if these record earnings won't last, as if silver is on the verge of a massive collapse. But all the real-world data, the physical supply data, the backlogs at refineries, the delivery delays, the shrinking inventories at the major exchanges, it all tells the complete opposite story. This is not a market that's swimming in excess metal. This is a market that is running incredibly tight. So the big question is, why aren't the stocks reflecting that reality? The answer is because the price discovery mechanism in the paper market is still dominating the narrative. I'm talking about futures contracts, options positioning, algorithmic trading, high-frequency liquidity games. All of these complex financial instruments can be used to suppress prices temporarily. They can create a false narrative for a short period, but they cannot change the fundamental reality forever. And when that suppression finally fails, and it always does, the repricing happens fast. It happens violently. And it happens with almost no warning. This is exactly why what we're seeing right now in the price action is so critically important. Because when the mining stocks stop falling, while the metal itself is still under pressure, that usually marks the end of the selling phase. It's a sign that the sellers are exhausted, They've thrown everything they have at the market. It's not going down anymore. And it means the smart money, the buyers, are already positioning for the next leg up. They're not chasing headlines. They're not reacting emotionally to the day-to-day noise. They are quietly accumulating, buying shares from the sellers before the rest of the crowd wakes up to what is really going on. And let's be honest, the crowd always wakes up late. Right now, the story being pushed by the financial media is simple. It's predictable. They'll say silver ran up too far, too fast. The rally needs to cool off. Investors are rotating their money back into tech stocks and bonds. But that whole narrative completely falls apart the second you look at the miners' balance sheets. Their free cash flow is exploding. They're paying down debt at a rapid pace. They're increasing dividends to shareholders. Some are even starting massive share buyback programs. These are not signals of a sector that's about to collapse. These are the signals of a sector that is fundamentally, profoundly mispriced by the market. And mispricings never last, especially not in the world of commodities, where physical reality always wins in the end. Which brings us to the real question we need to be asking ourselves. If the miners are this undervalued, and if the physical market is this tight, and if the big institutions are known to be short, then what is actually happening right now? Why is the price being artificially pushed down right before a major options expiration? And most importantly, who benefits if the price stays down just a little bit longer? That's what we need to dig into next. Because the mechanism that's controlling the short-term price of silver isn't physical supply and demand, it's derivatives. And the entire derivatives market is about to go through a major reset. What we're witnessing isn't a normal market correction. It's a battle for control. And understanding who is on each side of that battle is the key to understanding where we go from here. Welcome back to the channel. Today we're talking about something subtle, something happening just beneath the surface of the market that most people are completely missing. It's that quiet moment in a cycle right before the chaos. On the surface, everything looks fine. The headlines are calm, the commentators are relaxed. But if you know how to read the tape, the price action is screaming a very different story. What we saw today in silver and the silver miners should not be possible in a normal, efficient market. It's a huge tell. Early in the session, silver sold off, and it sold off hard. It was a sharp, fast drop that sliced through technical support levels, triggering a wave of stop-loss orders. It was the kind of move that looks and feels like panic selling, designed to convince anyone with weak hands that the rally is officially over. But here's where it gets interesting. While silver was getting hammered, the mining stocks barely reacted. They didn't just stop falling, some of them actually started moving higher while silver was still under pressure. Now, that is not normal. In a healthy market, mining stocks are leveraged plays on the metal itself. They're supposed to move more than the underlying commodity, not less. When silver drops 4%, you expect miners to be down 6, 8, even 10%. That's just the nature of operating leverage and equity risk. But today, silver dropped hard, and the miners just shrugged. That isn't weakness. That isn't some random market fluke. That is a textbook example of relative strength. And seeing relative strength during a sharp sell-off is one of the most powerful signals professional traders look for. It's a sign that a trend is about to make a major reversal. It tells you that while the crowd is selling loudly, someone with deep pockets is buying quietly. They're absorbing all the selling pressure without letting prices collapse. Now, let's add one more detail that changes the entire picture. We are less than 24 hours away from monthly options expiration. This is, without a doubt, the single most dangerous day of the month for anyone holding a large short position. On options expiration day, billions of dollars in contracts either expire worthless or are forced into settlement. If the price moves against the big players, market makers and banks are forced to hedge their positions in the open market. This means they have to buy shares they don't want to buy at prices they can't control. This forced buying is what creates explosive, face-ripping rallies. And right now, the most important strike levels, the ones with the most open interest, are sitting right around the current price of silver. So what we saw today wasn't just about silver falling. This was a calculated effort to keep silver, and especially the silver miners, pinned below those critical price levels until the contracts expire. Because once that expiration window passes, the downward pressure vanishes, and the price is free to move again to find its true value. And that brings us to the elephant in the room, valuation. At today's prices, most major silver mining companies are generating profit margins that we've historically only seen during the absolute peak of commodity booms. Their all-in sustaining costs are relatively stable. Energy prices aren't exploding. Labor costs aren't doubling. But the price of silver is much, much higher. This means that every single dollar increase in the price of silver flows almost directly to their bottom line as pure profit. That is the power of operating leverage, and it is absolutely brutal for anyone shorting these stocks. Their earnings are exploding faster than their stock prices can possibly keep up. But here's the paradox. The mining stocks are still being priced as if silver were back in the $30 range. not where it is today. The market is acting as if these massive profits don't exist, as if these earnings won't last, as if silver is about to collapse any minute. But every piece of fundamental data we have tells the exact opposite story. Physical supply data, refinery backlogs, delivery delays, and shrinking inventories on the exchanges all point to the same conclusion. This is not a market swimming in metal. This is a market that is running incredibly tight. So why aren't the stocks of the companies that dig this metal out of the ground reflecting that reality? The answer is that price discovery in the paper market is still dominating the narrative. We're talking about futures contracts, options positioning, algorithmic trading, and high-frequency liquidity games. These are powerful mechanisms that can suppress prices, but only temporarily. They can create a false narrative, but they cannot change the underlying fundamentals forever. And when that suppression finally breaks, the repricing happens fast. It happens violently, and it happens without warning. This is precisely why what we're seeing right now is so important. When the miners stop falling, even while the metal itself is still under attack, it's often a sign that the selling phase has reached its end. It means the sellers are exhausted, and the smart money, the real buyers, are already positioning themselves for the next leg up. They aren't chasing headlines or reacting emotionally. They are accumulating shares quietly before the rest of the crowd even realizes what's happening. And as we know, the crowd always shows up late to the party. Right now, the story being pushed by the mainstream is simple. Silver ran too far, too fast. The rally needs to cool off. Investors are rotating back into tech and bonds. But that entire narrative completely falls apart the moment you look at the balance sheets of these mining companies. Their free cash flow is exploding. They are paying down debt. They are increasing dividends. They are even starting to buy back their own shares. These are not the signals of a sector that is about to collapse. These are the signals of a sector that is fundamentally, profoundly mispriced by the market. And in the world of commodities, mispricings like this never last. So that brings us to the real question we need to ask. If the miners are this undervalued, if the physical market is this tight, and if the big institutions are heavily short, then what is really happening right now? Why is the price being pushed down so aggressively right before options expiration? And more importantly, who benefits if it stays down just a little while longer? That's what we need to dig into next, because the mechanism that controls short-term pricing isn't the physical supply and demand you read about. It's the derivatives market. And that derivative market is about to hit a major reset point. Thanks for watching, and I'll see you in the next video. Have you ever watched a stock just sit there for months, even years, doing absolutely nothing while the fundamentals get better and better? And then one day, out of nowhere, it explodes. It doesn't just climb, it gaps up, it spikes, it completely overshoots. That's the phenomenon I want to talk about today, specifically with mining stocks. Because when these stocks finally reprice, they don't move slowly, they react to years of undervaluation all at once. This creates what traders call convexity. It's a powerful concept where a small change in the price of the metal, like silver or gold, produces a massive, disproportionate change in the mining company's stock price. It doesn't happen gradually, it happens suddenly. This is the magic of operating leverage when the market finally decides to recognize it. And if you look at history, this pattern is crystal clear. In every single major precious metals bull market, the miners lag behind at first. They frustrate everyone. Then they explode. It's not because the fundamentals suddenly changed overnight. It is because the market finally woke up and acknowledged the fundamentals that were already there all along. And right now, those fundamentals are staring us in the face. Cash flow for many miners is already high. They've been paying down debt. Their production is profitable even at current metal prices. The only thing missing from this perfect picture is price recognition from the market. So what's the trigger? What makes the market finally pay attention? Often it starts when the heavy positioning in the derivatives market begins to unwind. This is why the next few trading sessions could be far more important than most people realize. We're approaching a major options expiration date. After expiration, the big banks and institutional players lose one of their strongest tools for influencing prices, their massive derivative positions. Now, they still have influence, of course, but they lose that direct, mechanical leverage they use to keep a lid on prices. And historically, that's exactly when suppressed sectors often break free and begin their true move. Now, let's be very clear about something. This does not mean we're heading for a straight, uninterrupted line to the moon. Far from it. There will be intense volatility. There will be fake breakouts that suck people in just to reverse. There will be violent, gut-wrenching pullbacks that shake out the weak hands. That is simply how heavily shorted illiquid sectors behave when they start to turn. Trend shifts are never clean and tidy. They are chaotic, messy, and confusing. The earliest signals of a major turn are always subtle. For example, you might see mining stocks refuse to fall even when the price of silver or gold takes a dip. That's a classic sign of strength. That's not what a late-stage bubble looks like. That is what an early-stage rotation looks like, as smart money quietly moves in. And these rotations, These moments of transition are where the real money is made. Because by the time the story hits the mainstream headlines, the explosive part of the move is often already over, and the best valuations are long gone. Now, let's zoom out and think about the bigger picture, the macro conditions. Central banks around the world are still expanding their balance sheets. Governments are still running massive deficits, funding them with printed money. We have structural shortages in key industrial metals, and the global energy transition is accelerating, which requires a huge amount of these materials. All of this points to higher commodity prices in the long term. What this means is that even if silver has a temporary pullback, the mining companies themselves remain structurally profitable. This creates a powerful asymmetry. Their downside is limited because their businesses are solid, but their upside potential remains wide open. This is precisely the kind of setup that eventually attracts large institutional capital, not because these big funds have a sudden love for silver, but because they have a deep, unending love for profit margins. And the profit margins in the mining sector right now are extreme, yet they are still being almost completely ignored by the wider market. This means a repricing isn't just a possibility, it's an inevitability. The only real unknown is the timing. And as we've discussed, timing often lines up with these derivative market resets, which is exactly what we are approaching right now. So what should you, as a savvy investor, actually be watching? Forget the headlines, ignore the social media hype. Focus on 3 key things. First, watch the miners' relative strength. If the mining stocks are consistently outperforming the price of silver itself, that's a huge clue that accumulation is happening under the surface. Second, look for volume spikes. If you see trading volume surge but the price doesn't collapse, it means there's a huge amount of buying pressure absorbing all the selling. And third, pay very close attention to the post-expiration behavior. If the miners start to move significantly higher after these big options contracts roll off the books, it's a sign that the suppression has failed. That's the moment when the entire game changes. It's when positioning begins to shift on a mass scale. It's when the trend-following algorithms kick in. It's when the big momentum funds are forced to rebalance their portfolios and buy. And that's when these moves truly accelerate and go vertical. But here's the uncomfortable reality. Most people will not buy until the price move is already well underway and has confirmed the new trend. But confirmation comes after the big repricing has already happened. This means they will inevitably buy later and at much higher prices. That's not a criticism, it's just human nature. We're wired to seek safety in the crowd. Markets understand this psychology and they exploit it. They punish the impatient, but they reward the patient eventually. But that reward only comes if you're willing to tolerate the discomfort first. And right now, discomfort is the primary emotion in the silver mining space. The stocks feel slow. They feel manipulated. They feel incredibly frustrating. But this is exactly the environment where major sector reversals are born. Not when everyone is confident and celebrating, but when conviction is at rock bottom. Even though the fundamentals are screamingly strong, that is the sweet spot for opportunity. And that, in my opinion, is precisely where we are right now. So when people ask why silver miners are being held down, the answer isn't some grand conspiracy theory, it's mechanical. It's about short positioning in the market, it's about derivative exposure, and it's about defending specific price levels until options contracts expire. But once those mechanical pressures are reset, price has a tendency to revert back to the fundamental reality. And the fundamentals today are screaming undervaluation. This is why this moment matters. Not because I can guarantee a rally tomorrow, but because we are approaching the removal of a major constraint on the price. And markets make their biggest moves when constraints disappear. So whether the move starts immediately or takes a few more days to get going, the underlying setup remains the same. You have deep undervaluation combined with a tight physical supply of the metal meeting a major derivatives reset. That is the recipe for explosive repricing potential. This isn't hype, it's market structure. And in the long run, structure always wins. It's why serious investors are watching the miners right now, not meme stocks, not tech hype, not the daily news cycle. They are watching cash flow. And the cash flow is telling a story that the stock prices haven't caught up with yet. So when the suppression finally breaks, it won't look like neat and tidy good news. It will look like chaos. You'll see big, shocking green candles on the chart. You'll see short squeezes that defy logic. You'll see gap ups that leave people behind. There will be whipsaws that shake you out if you're not prepared. And by the time the financial media gets around to explaining why it all happened, the bulk of the move will already be over. That's how every major commodity revaluation in history has worked. It starts with slow, quiet accumulation by a few and ends with violent, sudden recognition by the many. And right now, all the signs are pointing to us standing right at that critical point of transition. Not because of wishful thinking, but because of the math, because of the market positioning, and because of the fundamental imbalance between price and value. Markets hate imbalance. They always correct it. The only question left is how soon. Thanks for watching. If you found this analysis helpful, make sure to like, subscribe, and hit that notification bell so you don't miss our future updates.